Ladies and gentlemen, you know why we're live. We're early, baby. We're no longer the late guys. We're going to be the early people, okay? This is the new thing that we're starting. Just kidding. This will probably be for a single day, but I'm here and I thought, why not go live anyway, All right. So, first off, as you guys can see down below, the call starts in 10 minutes. That being said, I wanted to go on live to hear some of your guys' thoughts on what we should expect from this call. I'll give you guys some of my sort of own predictions there, but then again, like maybe get some of your guys' things. Is the stock going to run? That sort of thing. But let me just make sure that I'm all signed on to this. Perfect. Okay, great. We're ready to rumble. Chris LaPointe usually does well with these chats, probably even better than Noto. Yeah, I mean, the thing is definitely true that Chris LaPointe is as much of a superstar as Anthony Noto. Together, they are a super team. Let's get the chats up on screen as well. Okay. Updates on crypto and SMB. I think you're going to be asking a little bit much for SMB comments. I don't know if we'll get anything along those lines. I mean, maybe marketplace stuff, but definitely not first party providing. Questions on, loan platform business, I think is really what's going to be top of mind. Credit card, more on the lending side. Remember, he is the chief financial officer. It's going to be very numbers driven. Not in the first beginning of the call. I think you're going to see a lot of just topics around, we're here to help save, invest, protect for all users, everything like this. But then go more into details that we haven't heard before. Maybe some tech platform stuff as well, because obviously there's been some concerns about Chime. That could be top of mind. They're about to go public this month. Actually, it'll be my next video. A little sneak peek, SoFi versus Chime. Pretty interesting debate, actually. So I'll be covering some of that probably tomorrow. It'll be same old, same old. It never is. Honestly, everyone says this about SoFi, but I always find I learn something pretty amazing during every fireside chat, even the last one. It started off slow for probably the first, 20 minutes. And then it was just a rapid fire of new products that they were expecting to come out with, like the interest-only payment personal loans. We heard a lot of stuff about the tech platform, the deals that they were ready to close, but, they haven't announced yet, which that's how we learned about the 10 deals. Stuff like this is really powerful as an investor. I think it's very transparent. So, yeah. You think they'll mention the new potential credit card from the survey? Not at all. I don't think they'll bring up that, but they'll talk about the defaults getting better on their existing business. I don't think they'll make too many assumptions in that regard. Okay. Just popped up William Blair's thing, so presentation should start soon. I'll even put up the music a little bit just to make sure that we're not missing anything. All right. It doesn't say, it says presentation will begin soon. In fact, I even see the Wi-Fi network and password on the thing. So potentially there is a full presentation, but I can't believe that to be so. I didn't know that this was going to be a video presentation. If it is, awesome. We'll be able to share that with you guys as well. But it's my understanding almost none of these ever are. Okay. SoFi is an unnecessary company in the world? I don't think so at all. There's very few companies that can do what SoFi does. And if it wasn't for SoFi bringing out the products that we have today, I think, large banks would continue to offer not even just the bad rates that they offer today, but potentially even worse. Potentially the reason why they are able to offer products that look somewhat like fintech is not out of niceness. It's because there's competition that helps them or forces them to be more competitive, which is always good for us. So fintech is a massive, massive benefit to the world. Okay, 6 minutes left here. Hopefully they announce crypto. I don't think in any of these fireside chats will they announce something that is going to go live after the announcement, but they could definitely talk about how close they are. I think that could be very interesting. It's weird they're doing it after hours. Yeah, I think it's mainly just based on the William Blair conference and the timing that they got placed in the conference rather than anything that SoFi had control over. They're talking to a bunch of different companies, so they just bring on CFO or CEO one after another after another. That's why you always see the fireside chats all being within a very similar time frame, is because this is usually whenever the big banks, different equity research companies, large tech companies are doing these conferences. So he's put into a time slot. I wouldn't think too hard about the actual timing of the event. Yeah, guys, right now I understand that sentiment is low on SoFi, even though financially they're doing quite well. I think that this is a company that is being very well misunderstood right now. Like, I'm not seeing any statistic that is showing that we're actually seeing bad performance. In fact, this Chime IPO is, not to give a little bit of an update to my video, but it does make SoFi look strong. It looks really strong. So I don't know. I'm very excited about SoFi's future as long as they can continue to compound at the rate that they've been compounding. Imagine they don't get a tech multiple or whatever we saw in that debate. Imagine just buying a company that is compounding at a 30% rate. And on the bottom line, potentially even better than that. Because if you're talking about net income margins, okay, you are seeing a percentage of how much top line growth or revenue growth that a company is bringing in, okay? If they can continue to compound that revenue growth at really high rates, let's say 30%, next quarter will be even higher than that, probably 40+%. But if they can continue to hold up those levels, then the margin means that the net income will also grow at 30, 40%. But that's not what we're seeing. We're actually seeing margins improve, and incremental margins are, we could see by incremental margins that continues to push up every quarter. So that means that the bottom line is growing faster than the top line of 30, 40%. So if margin doesn't expand, fine. Okay. But that means that the multiple that we get that stays consistent is of a multiple of earnings that is growing 30 to 40%, which if you just annualize that out, that's doing much, much better than the actual S&P 500. Now, that's not the way companies work, right? Companies are not just trading a consistent multiples and, they just go up in a linear path. Because if that was the case, SoFi stock would be doing amazingly. But really what happens is that we're seeing it in crazy volatility. So flat for long periods of time, and then those 30% growth rates get bundled together, and then we see 100% pop, right? 7 to 14 type events like what we saw recently. And I think that just might be SoFi's sort of trading habit that they get into. Might even be tradable for some swing traders, is to try to find SoFi whenever it does have those pops and then abandon it and look for other opportunities while it sits in a range-bound area. Now, I'm not smart enough to find those areas. I don't know how I would even go about doing it. So I stay an investor, and I'm hopeful for holding onto a company that's compounding at a 30, 40% rate. That's fine with me. If they can continue to do that, however. Now, looks like we're about to get started. They just brought up another thing here. I don't think there's going to be video. Doesn't look like there's going to be video. But I'm actually not getting any audio, which is interesting. Let me just refresh this, make sure that we're all good. I could show you guys here for a second what I'm seeing, but I'm not actually getting any audio. This is what we're seeing right now. As you can see, the volume is cranked. You guys can't hear that, right? Let me know if you guys can hear anything, because maybe it's all faulty or something. Oh, it looks like there might be an investor presentation that they end up using. Okay, we have audio.
That's my cue that it's time to start. So let me just read off the disclosure here. My name is Andrew Jeffrey. I'm the fintech analyst at William Blair. And I'm required to inform you that a complete list of research disclosures or potential conflicts of interest are available on our website, williamblair.com. It's really my pleasure to be able to introduce Chris LaPointe, the CFO of SoFi. This is one of our favorite names. Anybody who's talked to me about this knows how enthusiastic we are about SoFi. Very thematically, we believe that there's a structural shift taking place in U.S. consumer finance whereby younger consumers, especially as they become more affluent and advance in their careers, are increasingly going to be and have become dissatisfied with traditional banks. They want better experiences, they want better products, they want fairer products, they want faster credit decisions. And SoFi, by being a vertically integrated digital bank that's very thoughtfully built and thoughtfully run and continues to evolve its products, we think fits into that theme extremely well. And with that, I'll let Chris walk you through the presentation.
Excellent. Well, thank you very much. Good afternoon, everyone. Thanks for having me, Andrew. It's a pleasure to be here at the conference. Here's our quick disclaimer as well, which is on our investor website, which you can all read at your leisure. But here's what I'm going to cover today. So some of you may be new to the SoFi story. So today I'm going to cover our differentiated business model, the significant growth that we've delivered over the course of the last several years, and the incredible opportunity that we have ahead of us. Overall, we haven't been this excited or confident in our business than we are today. So let's start with our mission and strategy. As SoFi, we're building a mission-driven company to help people achieve financial independence in order to realize their ambitions, which means helping our members get to the point where they have enough money to do what they want. That means having the family that they want, the career that they want, etc. In order to do that, we need to have a lifetime relationship with them and be there for all of their major financial decisions and every day in between. Everything that we do at SoFi is guided by our focus on helping our members get their money right, and we're achieving this mission by being the only digital one-stop shop for financial services in the marketplace today. We offer a comprehensive set of products and services to help our members borrow better, save better, invest better, protect better, and spend better, all of which are seamlessly integrated into our digital platform. We aim to be the best in class across each and every one of our products, but we also believe that our products work even better when they're used together. Across each and every one of our products, we want to differentiate them by providing the best speed, the best selection, the best content, and the best convenience. This means being the fastest place to open an account, providing the most comprehensive selection of features, providing a number of ways to move money seamlessly, safely, and efficiently, and bringing products and insights that were once reserved for the ultra-wealthy to everyday people in a digital and easy-to-use fashion. Unlike the traditional financial institutions, we have a technology DNA and are unencumbered by outdated technology or bureaucratic silos that get in the way of the member experience. This allows us to innovate and scale the business at a much more rapid clip. So our one-stop shop strategy also leads to a sustainable competitive advantage, which is being able to produce the highest lifetime value per member at the lowest customer acquisition cost. So here's how it works. We end up attracting new members to SoFi through any one of our new products and having a trusted brand name and exceptional products. Once a member takes out that first product, we build that trust and loyalty with them such that they have a higher propensity to take out additional products. For example, during the first quarter, nearly a third of all new products that were opened up came from existing members on the platform. When that member takes out a second product, we don't have to pay the second acquisition cost, which essentially allows us to drive a very high lifetime value per member at a much lower customer acquisition cost. Having these really good unit economics allows us to reinvest in our business, which provides the member with better products and better services, better pricing, and better selection. This flywheel effect, which we end up calling our financial services productivity loop, ends up powering our continued growth. And the opportunity in front of us, as Andrew mentioned, is massive. Half of the American population is digitally native, and at the same time, there's a growing mistrust in traditional banks. We're here to provide a much better option that is truly member-centric. So this next page shows how our business has evolved over time to becoming a strong, diversified business that it is today. Starting around 2018, when Anthony and I joined the company, we invested significantly in improving existing products and bringing new products to market. Over the past several years, we've launched our SoFi Money product, our SoFi Relay product, SoFi Invest, SoFi Protect, SoFi Credit Cards, in-school student loans, home equity loans, and we've strengthened our capabilities with strategic acquisitions of Galileo, Technisys, and Wyndham Capital Mortgage. Along the way, we've consistently rolled out new products and innovative features. For example, we were pioneers in fractional shares and bringing alternative investments and IPOs to everyday people. Today, the SoFi platform has a full set of financial services products, but we're never going to stop innovating and bringing even better products and features to our members. Just this quarter, we ended up announcing a new personal loan and a student loan refinancing new product. And given the changing regulations, we're also actively exploring opportunities of bringing crypto and blockchain technology offerings across our business. Given our broad product offering and technology platform, we believe that there could be meaningful benefits for our members and our business. So what has been the result of all of this innovation and brand building? We've seen exceptional member and product growth. Since we went public in 2021, we've scaled both our members and products at a compounded rate of over 50%. We now have approximately 11 million members and over 15 million products, and we believe we're just starting. In fact, the last quarter was our best quarter ever in terms of overall member growth and product growth. We ended up adding 800,000 new members, which was up 34% year over year, and we added 1.2 million new products, which was up 35% year over year. Our member and product growth are the leading indicators of our overall financial performance. From 21 to 2024, we ended up growing adjusted net revenue at a 37% CAGR. And this year, we expect to generate well over $3 billion in adjusted net revenue, which is up more than 3x of what we delivered back in 2021. We also meaningfully improved our profitability by delivering $666 million of EBITDA in 2024 at a 26% margin, while net income was $227 million at a 9% margin. And I'm going to provide a little bit more detail on profitability in a moment. But first, I want to start by talking a little bit about the diversification of our revenue. So as we've grown our business, we've also taken action to diversify our revenue streams. This has meant broadening our sources of income to include more fee-based revenue, which is capital light, has a higher ROE, and gives us greater durability throughout cycles. Our fee-based income comes from a variety of sources, including origination fees, referral fees, interchange revenue, brokerage-free revenue, and our loan platform business, which I'm going to hit on here in a minute. In 2021, our fee-based revenue was about 26% of total revenue, and in the first quarter of 2025, it comprised 41% of overall revenue. On an annualized basis, we generated $1.2 billion of fee-based revenue in the first quarter, and we continue to see meaningful upside there. Beyond the top-line growth that we've exhibited, we've also strengthened our return profile. We ended up turning profitable in Q4 2023 and have since delivered 6 straight quarters of net income profitability. Our annualized ROTCE was about 6% in the first quarter, but over the long term, we see our business as being capable of generating an ROE in the 20 to 30% range while still generating significant growth. Ultimately, we're focused on generating an attractive mix of durable growth and strong returns for our shareholders. Let me now turn to the segments, starting first with our financial services segment, which has been a key driver of our overall growth and revenue diversification efforts. Our financial services segment includes our SoFi Money and SoFi Invest businesses, our credit card business, and our loan platform business. Year over year, revenue has doubled while also nearly doubling our contribution margin to roughly 50%. Non-interest income in this segment, which is primarily fee-based income from loan platform business fees, brokerage fees, and interchange, has increased 4x. Let me now spend a few minutes talking about Relay and SoFi Plus, two of our financial services products that are integral to our strategy and demonstrate the power of our one-stop shop model. Our Relay product allows members to understand their spending patterns across their accounts within and outside of SoFi. We've seen tremendous scale in indirect value creation from Relay, which is now over 5 million products and grew 41% year. Relay is an important product because it serves as the tip of the sword, attracting new members to SoFi and then driving attractive cross-buy patterns into SoFi products. As an example, a third of Relay First members that cross-buy adopt over 3 products today. SoFi Plus, on the other hand, is our premium membership tier, bringing together the best of all we have to offer across our products and creating over $1,000 in value for our members each year. Until recently, these benefits were accessible to members by setting up a direct deposit, but more recently, we've created a subscription fee option where members gain access to these premium services and more through a $10 monthly fee. While this subscription option is still new, we're seeing very promising behavior among our new subscribers. For new subscribers to the program, 90% of them were existing members on the platform, and a third of those took out an additional product within 30 days of enrolling in SoFi Plus. And then of the remaining 10%, at least 75% have taken out a second product, and 40% have taken out a third product within just 30 days of enrollment of the subscription service. The success of these products obviously shows that members truly value our one-stop shop model and further demonstrates our financial services productivity loop, which is a key part of our overall strategy. So I now want to spend just a minute discussing our SoFi Money business, which we see as our next billion-dollar revenue business. In 2022, we ended up receiving our banking license, which gave us the opportunity to provide deposit products to our members, which is critical in becoming their primary financial services provider, while also significantly reducing our overall cost of funding for our loans, which historically were funded through warehouse providers. This was a critically important development in our strategy and has been one of the key differentiators versus our peers. In just a few years, we've grown our deposit base to over $27 billion in deposits, which has strengthened our balance sheet with durable, sticky consumer deposits. Today, over 90% of all of our member deposits are coming from direct deposit members, and over 97% of those deposits are fully insured by the FDIC. How have we been able to grow these deposits so quickly? First, by providing an unmatched value proposition that is both easy to use and is very fast. We're the only company that allows our members to move money in a frictionless way through digital person-to-person payments via a phone number or an email address and via Zelle, ACH, or self-serve wires. Second, we're offering a very attractive APY to our members that is typically in the top quartile, while the big banks are offering a couple of basis points. Because of our business model and the attractive loan yields that we generate, we're able to offer a strong APY while still maintaining a healthy net interest margin well above 5%. In addition to the member benefits, we have a strong deposit base that has enabled us to lower our funding costs, saving us an estimated $515 million per year versus what we would be paying for warehouse funding had we not obtained the banking license. SoFi Money has essentially become a game changer for our business. Turning now to our lending segment, which is currently our largest and most profitable segment overall. Within this segment, we offer personal loans, student loan refinancing, in-school loans, and home equity loans. In the first quarter, this segment delivered over $1.6 billion of annualized adjusted net revenue and has consistently delivered a contribution margin in the range of about 60%. Our largest category of loans is our personal loans, which are used to consolidate more expensive credit card debt and a variety of other uses. Personal loans saw our best quarter ever in Q1 with over $5.5 billion in total originations, and we continue to see really strong demand in that product. Our student loan business is primarily student loan refinancing, which has meant that we've faced headwinds in recent years from the student loan moratorium and higher interest rates. However, with student loan payments starting to resume, we're starting to see positive momentum in that business and an acceleration in originations. First quarter originations were up nearly 60% year over year. And then our home lending business faced some headwinds from higher interest rates over the course of the last few years, which has given us the operational and servicing, which has provided some real headwinds, but we haven't just sat there idly. We took that time to redesign and redevelop that product. First, in 2023, we ended up acquiring Wyndham Capital Mortgage, which has given us the operational and servicing capabilities to scale our home loans business. And then second, in 2024, we ended up introducing a home equity loan product. And this product has diversified our growth, which has made the business much more durable through various rate cycles. This product, which we didn't have just a year ago, accounted for more than a third of our overall home lending volume during the first quarter, and it was our best quarter ever for home equity originations, and this should only improve from where we are today. When interest rates come down, we do expect to see an acceleration both in our student loan refinancing business, as well as for demand in our home loans, as we're well positioned to capitalize on the opportunity. So let me now zoom out for a second and discuss a relatively new business that has really transformed our lending platform capabilities. Historically, we would originate loans, hold them on the balance sheet for a period of time, and then sell or securitize through the capital markets in order to manage our balance sheet capacity. We continue to do this through our lending segment today, and it's a great business, but it is also capital intensive. Last year, we ended up creating more optionality to meet the strong demand that we have both from members as well as capital markets participants through our loan platform business. Here's how this business works. So we end up partnering with loan buyers in the capital markets, such as Fortress and Blue Owl, and we deliver loans that meet their specific investment needs. We earn a set fee per loan that we deliver, and we retain the servicing of those loans and the membership relationship, giving us great cross-buy opportunities. Importantly, we move these loans to our partners in a matter of 2 to 3 days, so we are not bearing any of the ongoing credit risk or capital requirements. Our loan platform business is allowing us to significantly scale our origination volumes without growing our balance sheet beyond our stated targets. This has been a huge unlock for us over the course of the last few quarters. In the first quarter of 2025, we ended up originating $1.6 billion of LPB volume and generated nearly $100 million in total LPB revenue. In the second quarter, we expect another meaningful increase in both volume and revenue. So far, the vast majority of loans that we've originated through the loan platform business have similar characteristics to what we would hold on our balance sheet today. However, we see further opportunity to originate great loans that are outside of our very narrow credit box, which would open up in an entirely new market for our business and allow us to monetize a portion of the roughly $100 billion of loans that we're currently turning down in the personal loans business on an annualized basis. When we add our LPB to our originate to sell business, we now have the continuum of options that allow us to generate consistent growth and attractive returns in a variety of economic environments. I would note that the capital markets demand for our loans continues to be extremely robust, and that continues into Q2. During the first quarter, we sold and transferred through our LPB business $3.1 billion of personal and home loans, and we have not seen any signs of slowing. Turning now to credit, I want to reiterate that we do not retain any credit risk associated with our LPB loans since we moved them to our partners shortly after origination. For our balance sheet loans, we've seen credit improve with net charge-offs for our personal loans and student loans continuing to decline this past quarter and sequentially. Our borrowers continue to be really strong and healthy. The average FICO score of our borrowers are around 750, and they have strong average incomes, averaging about $134,000 for student loan borrowers and $158,000 for our personal loan borrowers. Staying on credit here for a moment, we underwrite on the personal loan side to a 7 to 8% average life of loan loss. If we compare our recent vintages back to 2017, the last vintages to reach that or close to approach the 7 to 8% level, we see that losses are trending well below that level. In fact, the gap between the newer cohorts that we've originated ended up widening by a more favorable 16 basis points this past quarter after widening of about 15 basis points in Q4. Additionally, looking at our Q1 2020 through Q4 2024 originations, 59% of principal has already been paid down with 6.7% in cumulative losses. Therefore, for our life of loan losses to end up coming close to that 8%, the charge-off rate on the remaining 41% of unpaid principal balance would need to be approximately 10%. And this would be well above past cohorts at similar points of seasoning, which further underscores our confidence in achieving life of loan losses below our 8% threshold. Turning now to capital. On top of our regulatory minimums, we maintain an internal stress buffer, which determines the minimum capital level where we feel comfortable operating given the composition of our balance sheet, our growth opportunities, and the current environment that we're in today. At the end of the quarter, we had a total risk-based capital ratio of 15.5%, which included incremental capacity beyond our internal stress test buffer and is well above the regulatory minimum of 10.5%. Turning now to our tech platform segment, which offers businesses the ability to launch and run financial products from bank accounts and debit card to ACH and wire payments to BNPL and more, as well as offering a cloud-based core banking system. Our tech platform business also underpins our SoFi product offering, allowing us to launch customized products for and expand more rapidly and effectively. For example, we have a Pay in 4 product and our self-service wires that we recently rolled out. Those were built entirely on our in-house tech platform. We were able to build and launch these products in a fraction of the time and at a much lower cost compared to a bank operating on a legacy platform or by partnering with another third party. Our revenue generation and margins have been steady. However, we have recently diversified our client base to provide incremental growth opportunities, and we're seeing really good momentum today. We've had a diverse set of client wins, including financial services firms, government programs, and large consumer brands. In this business and the opportunity we will see as these newer deals start to generate more meaningful revenue over the course of 2026. So over the past few years, we've overcome significant headwinds, including the sharp rise in interest rates that brought down several major banking institutions, as well as a moratorium that we faced on our largest, most profitable business in student loan refinancing. But despite those headwinds, we grew substantially. We ended up strengthening our returns and also built a more durable and diversified business. We're now an even stronger business, better positioned to take advantage of the significant opportunity in front of us. And as we approach the midpoint of 2025, we have really, really good momentum. Our first quarter was one of our best quarters ever with record member and product growth, record revenue, record originations, strong credit, strong capital, and new product innovations across the board. Our strong Q1 in terms of overall financial performance has allowed us to increase our outlook for the remainder of the year across all key measures. And we stated that during our last earnings call. In particular, we were able to raise guidance on an adjusted net revenue to $3.235 billion to $3.31 billion, which equates to year-over-year growth of approximately 24% to 27%. We now also expect adjusted EBITDA of $875 to $895 million, adjusted net income in the range of $320 to $330 million, and adjusted EPS of 27 to 28 cents, which is above our prior guidance of 25 to 27 cents. We've also increased our medium-term revenue guidance, covering the period of 2023 to 2026, to now be above 25% annualized growth. And we're really excited about the opportunity ahead of us and looking forward to the rest of the year and the year ahead of us. Thank you.
Thanks, Chris. Awesome. So we've got about 5 minutes left in the formal session before we go to breakout. So I'm going to ask you a couple questions just for the group's benefit. So clearly you've seen really good demand for your paper. Can you talk about product demand? Get a lot of sort of macro questions, and I guess part of that is sort of broad product demand, and then part of it is to drill down on sort of the dynamics within student loans. I mean, on one hand, you could see increased demand for student loan consolidation, I assuming, and/or personal loans. On the other hand, there may be some concerns about sort of the credit quality associated with those products. So a couple of questions in there.
Yeah, absolutely. So overall, across the board, we're seeing really strong demand for our products, which is obviously a reflection of the relentless focus that we have on innovation and brand building. Like I said, we just reported our best quarter ever for member and product growth. We ended up adding 800,000 new members, 1.2 million new products, growing to nearly 11 million members and 16 million products. Cross-buy that we're seeing from existing members continues to be extremely strong, and it accounts for roughly a third of all new products that are taken out in a given quarter. That's been consistent for the last few years. And then we also had our best quarter ever in terms of overall loan originations at $7.2 billion in total. Our members today remain extremely strong and active. During the first quarter, we ended up seeing about $16 billion of annualized spend across both our debit and our credit products, and that continues to grow and accelerate. And then on the tech platform side, we've diversified our business beyond the traditional fintechs and are now working with large government programs, consumer brands, in addition to the traditional banks and fintechs. Our recent wins and others in RFP processes are going to have a meaningful impact in 2026 and beyond. As it relates to some of the student loan stuff that you're talking about, overall, we see a few dynamics at play. The resumption of federal student loan repayments we view as a positive tailwind to our business. As federal borrowers go back into repayment, many are going to look to us to refi at a much better price that we can offer relative to where we are. Right now, there's about a $280 billion total addressable market that we calculate for borrowers who are directly within our credit box and where we can price the product today. And we have a very large market share of north of 60%. So we feel good about continuing to be able to scale that business, particularly as people start to resume payments. I think the second tailwind that we expect is if rates do, in fact, come down, we view that as another really good tailwind to that business. When Fed funds was in the 1.75 to 2% range, we were originating at a quarterly clip of about $2.4 billion, which is about $9.5 billion annualized. Today, we're at about $1 billion. So meaningful upside in that business, and overall, demand for our products and our consumer remains extremely healthy.
Okay, awesome. So I think we'll call that the end of the formal presentation. And for those of you who would like to stick around for a breakout, please do. We're going to do it in this room since it's the last presentation of the day.
So, can you guys hear me, by the way? Yeah, it sounds like from the thing, I didn't actually take a look at the overall William Blair thing, but this seems to be the format that they were dealing with, where a bunch of companies were presenting what they end up doing to, I guess, a larger group of other businesses and potentially investors. Who knows? I would have hoped for a larger Q&A segment, but I mean, overall, sorry, the volume just turned back on. The sentiment in chat, though, that this was just absolutely devastational or something, I don't think so at all. I mean, there was nothing bad that they said, even one bit. Everyone's picking on his tone or whatever like this, but a day from now, it'll be a transcript and people won't know what the tone was at all. I think it was a good breakdown of the actual business. There were points in there that I thought were new or that needed to be refreshed that we haven't heard before. Okay. Even talking about the SoFi Plus subscription offer that's brand new, people thought, is this going to be a deal at all? Is it going to be important? And they said that they're actually seeing some pretty great behavior there. And they said 90% of the people who are choosing the subscription offer were existing members on the platform. A third of those took out an additional product within 30 days. And then of the remaining 10% that were brand new or members that weren't existing, at least 75% took out a second product and 40% took out a third product within 30 days. Okay. I think that that's pretty exciting. I was recently just reading the Chime S1, and they showed off each individual product that someone gets more and more and more of. Like what does a customer look like whenever they have one product versus the average customer that has 6 products with Chime? And the revenue is essentially multiples higher. A potential slide like this would lead investors, in my opinion, from SoFi's perspective, to understand what it means to cross-sell to multiple products. So hopefully that could be added to something like this. But overall, there's no harm in them coming out. We want them to communicate more. This is exactly what they're doing. They're going over why their flywheel is so freaking important. The size of the overall markets in lending, the comments like during the first quarter, we sold and transferred through our loan platform business $3.1 billion of personal and home loans, and we have not seen any signs of slowing. Okay, so if we get the same quarter, if not more, in terms of loan selling and loan platform, this will be a smashing success quarter coming up, Q2, because Q1 was a much higher in terms of the loan performance than what we were expecting, right? So that was pretty exciting. He also talked about, he said, we underwrite on personal loan side, between an average life of loan loss between 7 to 8%, which it's always been 8%, but 7 to 8%, sure. If we compare our recent vintages, back to 2017, the last vintages that reached that level were approximately 7 to 8%, but now we're seeing those losses are trending way below that level. In fact, the gap between the newer cohorts that we originated ended up widening that gap even more favorably by 16 basis points in the past quarter, after widening it even more 15 basis points in Q4. So they're saying every quarter we're getting better at underwriting. That's pretty exciting. Okay. People could say, oh, well, it's just a bank. Guys, you're acting like we're not investing in a financial solutions company. Okay. A large part of their success is their ability to underwrite, but that doesn't mean that the stock is held down. Look at Upstart, look at Affirm. Okay. Those companies, all they do is underwrite, and yet they can have massive multiples on their companies. So if you guys are wanting pure play internet companies, something like that, SoFi is not the company that you're looking for. Okay. What this is a digitally native company that's betting on the total addressable market of like users, bank users, going more online and not putting up with the bad quality, the bad service, the bad rates that large banks are going to offer their consumers. How big is that market? It's a $25 trillion market, okay? It's absolutely massive. That's what he was saying in this call as well. They're now breaking out of just the credit box that they're doing. They're underwriting at better rates. They're doing this for more customers. They're seeing flywheel effects and network effects of people taking out more products. Everything that they're wanting to see is essentially happening right now. But the market doesn't understand that, like even what we did in the debate, that the margins look low right now. But that's not what the incremental margins are showing. The incremental margins, meaning how much they're stacking on top of that each time, means that we could essentially get to roughly 30% or 40% in adjusted EBITDA margins. That's extremely competitive. Net income margins also getting to 20, maybe 25%. Very competitive. Okay. Those things are very exciting. Matt Money says Tanner admits SoFi isn't a tech company. I think that they're a tech-enabled business. What I think that means is, like, if you look at any company, they're all very well using a lot of technology. I would not call those tech companies, right? In the definition that Steve gave in the debate of what is a tech company, I would not consider SoFi a tech company. But I also think that the idea of a tech multiple is dog shit. I think that companies should be based on their increasing level of growth and then the margins that are behind that. So companies that have low growth and low margins deserve low multiples, which historically can be financial services companies, or the potential of risk that there could be failures. Like, financial solutions companies can make a ton of money, but then if they get something wrong, they can just, the next day they could be worth nothing, like Silicon Valley Bank. But overall, like, I think if they continue on the path that they're currently doing, which is roughly 30% growth rates in members, ever increasing margins on those users, at least for the next foreseeable future, like the next 4 or 5 years of growth, we're probably going to see higher and higher margins. I don't see how that doesn't equate to a higher margin. People can slap a sticker and go, oh, well, the market will look at it like this. Well, why isn't the market looking at Affirm that way, or Upstart, or the other ones? Oh, because SoFi decided to go and get a bank charter, which only means that because they report to other institutions like the Federal Reserve, the SEC, the OCC, that they can actually have better margins. They don't have to partner with other businesses. They're actually being more vertically integrated. That means that they deserve a worse multiple. I don't believe it. Other companies have done that in the past, and they've through their success, not traditional banking products, through other products, have led them to have massive success. But I think SoFi is going to do the exact same. From the products that they're putting out on personal loans, like whenever people go, oh, I mean, they're selling all traditional financial services products. We're not even seeing that. Like, even the idea, like, everyone talks about, oh, the traditional SoFi private student loans refinancing. Yeah, I mean, those have been around since 2011. Yeah, why do you think that is? Because of SoFi, okay? SoFi is the guys who created these types of products. So even now, in the personal loans that are being created, instant funding, potential interest earning, like interest only, but starting only, and then it gets into paying off principal. These types of products are just very unique for the industry that we're in. So they could be very well expanding the total addressable market of things like personal loans. Historically, I think in America, personal loans make up for about $170 billion of total addressable market. But there's an entire credit card market that could be tackled by these new style of personal loans. The reason why they haven't worked that way before is because they take very long times. They're not really equipped to be revolving. So, like, new amounts that you put on your card is not easily paid off. It never really worked that way. There was origination fees, which means, like, whenever you sign up, you have to pay an upfront fee. Like, it just didn't work, right? It didn't work for that cohort of individual. Now, with interest-only personal loans that are instantly funded, can be paid directly to your credit card issuer. Like, these are designed to tackle and lower the cost of credit cards. Okay. it's tackling a completely different market. So that's why you're seeing the growth rates grow much faster than, traditional financial companies. So as long as they continue to cross-sell at faster, by the way, Chime is like, I'll give you guys a little tidbit here. Tomorrow, I'm putting out my video on SoFi versus Chime. Chime's about to go public at a $11.2 billion market cap, which is actually lower than SoFi. Now, they at one point actually got valued at $25 billion. So that got slashed pretty hard. But $11.2 billion. Whenever I tell you guys that comparing the performance of a company that has been held to like the highest standard, Chime is like, people have compared it to like Revolut and EU, and it's like amongst the best American fintechs that you could possibly point out. Guys, tomorrow, whenever you guys watch that video, you'll be surprised at how bad they've done against SoFi on a financial standpoint. And then whenever I tell you that 11.2 billion versus the valuation that we're getting for SoFi right now also makes Chime look expensive or SoFi look very cheap. Okay? We'll talk about that tomorrow, but I'm just saying, like, the stars are aligning. The stars are showing. If I was an astrology guy, if I was a, technical analyst, which is not even really true, this is more fundamental, but that the market is willing to take on the risks of worse, but new fintechs. And now we have one that's been in the market for some time that is gotten to maturity much faster, much higher compounded annual growth rates. Pretty excited. Pretty freaking excited about SoFi's future if they can continue that level. Now, you guys can say all you want that, oh, it's a bank, yada, yada, yada. You're in the wrong investment then. I don't have to preach that every investor should be interested in this type. But if you guys are interested in what, financial companies or like fintech investments or what are the potential margins for those types of businesses, SoFi seems undervalued versus its peers. That is for dang sure. If you compare them against just general businesses, they seem very cheap versus the growth rates. So, but it can be one of those things, right? The market can be irrational longer than you can stay solvent. So, like, I don't know when this is going to happen. People want me to answer, okay, Tanner, but when? I don't have those answers for you. The problem is that it's hard to rotate out of SoFi and put it somewhere else because you don't know if that's going to be tomorrow, and you don't know that that's going to be 2 years from now. Okay, so if I were to say, what would Peter Lynch do here? Buy companies that consumers find is really good approach. They're growing, and let the market catch up later on. But that's not something that I can control. It has a bank, but it's not the only part of the business. So I wouldn't consider that it should be valued like a bank. I care about SoFi being disruptive in its addressable market. Yeah, so tell me if you think that they are, or if you don't, Tom. Because I think that a lot of the customers from SoFi are, especially in this industry, are looking at them through one product lens, which is SoFi Invest, which I think historically has been left behind. Okay, what they don't look at them through the lens of are products like personal loans, home loans, student loans, or any of those types of products, because even those products tackle just a much smaller audience. But in terms of the revenue per customer on those products, you can get into the 5 digits in terms of the profitability per customer. You can make thousands and thousands and thousands of dollars per customer. We're not talking $88. We're not talking $50 per user. We're talking thousands and thousands. And it's just hard to get customer surveys or customer sentiment from products that are for a specific person in a specific period of their life, right? That being said, though, SoFi Invest, I think you're going to see over the next 12 months a lot of innovation from SoFi Invest. My understanding from what I'm seeing in the careers pages or like the careers posts and the different products that they've rolled out recently is that SoFi Invest is probably on Technisys now because job offerings are across SoFi Invest, SoFi Money, and SoFi Credit Card. Historically, that has not been the case. So we're seeing the first job offerings across all three. If I were to look at that, I'd say that's probably due to some level of, similar tech stack. And we've known that SoFi Money has been on Technisys. So I think that that's going to be proven true. Maybe that's next quarter they announce that, who knows? And also it's expected by around this point, 2025, potentially midpoint 2025. So that looks to be lined up. And then on the next part of that, you're seeing the new push notifications for SoFi are insane. And I know what you're saying, like, oh, push notifications, doesn't seem all that exciting. But Robinhood has been talking about how they've really wanted great push notifications. They want, like they announced an entire product around it. Robinhood Cortex is going to enable AI to find the news in real time to tell you why stocks are going up or down. SoFi does that today. You don't have to worry about that into the future. They do it today. No one talked about it. No product announcement released. Okay. Analyst tools. Freddie announced it. It's fantastic. So you can go in, you can see not only just what the average analyst is pricing a certain company at, but you can see their entire history with that company. You can see their latest report. You can see the entire, I'm freaking sponsored by TipRanks, but you don't really need TipRanks if you have a SoFi account because they have everything that it offers directly in app. So like these sort of things are brand new to SoFi Invest particularly. They're talking about rolling out crypto. They're talking about rolling out level 1 options all by end of year. Okay. So I think that there's a new push for SoFi Invest, and you're probably going to see over the next 12 months that is a massive initiative for them. If you talk about sentiment from investors, which is what we get here, the 750 plus people that are watching right now, investors. If you guys are SoFi Invest users over time, you're going to see a real shift in how they feel about SoFi because their main product is going to be greatly affected. You don't really see a whole lot of critique from the SoFi Money users. You don't see a whole lot of critique from those individuals, right? The credit card works perfectly fine. The cash rewards get paid out exactly where you want it. Like we've heard no problems there. We haven't heard any problems from mortgage people, personal loan people, anything like this. No real relay concerns. Everyone loves the product. Actually, that's not true. There's some connectivity issues with certain companies, but it's actually not SoFi's fault. It's their partner with Plaid, right? And there's really not a better partner than Plaid. Like they're kind of the complete industry leader in the work that they do. So they just need to continue to roll out. Why doesn't SoFi announce this stuff? I completely agree. This is what I think is the biggest problem with SoFi is communication. But then whenever they come out and let's say William Blair's conference was, hey, do you want to come pitch your company? And they go, no, people can watch our earnings results. We're a public company. Then us as investors would have went, hey, come on, just do it. You don't have an hour to share with your investors. And then they do it. They come in, pitch their company, do the whole thing. And then you guys go, oh, this is crap. Where's the energy? Blah, blah, blah. I don't know. The guy's a CFO. Okay. He's the top accountant of the business. I wouldn't necessarily call him the hype guy. Still, I'm happy that they did this. I'm happy that I hope they do more. This is not even the last one. They signed up 2 firesides this quarter, at least so far. And hopefully they just continue to roll out better and better communication. If you think about a company like Google, and I'm a fan of Google, okay? But they have an existential threat to their business right now through artificial intelligence. And people are going, SoFi's uninvestable because they have bad communication. As if that's an existential threat, okay? Oh, if I was Anthony Noto, you hear every person online say, hey, the management and the company need to communicate their offerings better. Fair. Get a new PR team. Okay. Get someone that shadows Anthony Noto to push him to communicate on his off hours. Whatever. Those are all easily fixable solutions. We've heard Anthony Noto speak on conferences before. You can find any of those talks. He's even done talks for like Stanford and all these things. He's an amazing speaker. But I also think that he's just generally working a lot of the time. Is there room to do more communication? Absolutely. But yeah, it's not an existential threat. I own both Hood and SoFi, and it's apples to oranges. What I expect from both of them based on what they have both shown. I think whenever you're an investor, you can say that two ways. One, you want to be across different sectors, these sort of things. I don't know if you can say that about SoFi and Hood. Yes, the way that they treat their customers, the customers that come onto their platform, they're apples and oranges. I don't think that they will be generally taking customers from each other too often. Okay. That being said, I do think that it's fair to compare them because at the end of the day, as shareholders, the only number that we are looking for is shareholder or is the share price percent change over any period of time that you're looking at. SoFi, in that sense, can be compared to Robinhood. Okay. Where I think the problem lies is the timelines that people choose. The SoFi is going to be very linear in their growth. High growth, 30%. Let's try to hold that for years. Okay. SoFi or Robinhood is going to have periods where they have negative growth year over year, but they're also going to have periods where they have 3-digit growth, 100% year over year. Where does that look after a 5-year period, a 10-year period? People can say that favors Hood, but so far in public data, both of these are relatively new businesses. I know it doesn't seem like that because, they've been public since SPAC era, really, but that is still relatively new. So far, they look pretty even. In most recent history, Robinhood has been on one of those massive growth spurts, and so the multiple on the stock has skyrocketed. Okay. I also think that SoFi, especially since the loan platform business, should have not done what Robinhood has done. Obviously, they've been quite exceptional in recent history, but should not have been held to the levels that they're being held at right now. I think that it should probably be double where it is. I mean, around $25 a share. I think that would be a really fair price for SoFi. And then I would accept all the comments of people saying, this company is stagnant. It's not doing anything. And I'd just be happy holding my shares in the $20+ ranges. But yeah. The turtle, I mean, literally it is the turtle in the hare. I really do believe that. I don't know if the turtle always wins. Robinhood can definitely do some great things. I'm betting on both of them. But they are comparable. As an investor, they're comparable. Okay, let's see here. Hood has already made me money while SoFi will catch up. Yeah. Let's hope, right? Is SoFi bracing for the Hood product that was announced a few months ago? The banking products, you mean? I mean, in terms of bracing, I don't exactly know. What I think is interesting is that right now, if you look at the APY that Robinhood offers versus SoFi, Robinhood's is higher. Who could be higher while still maintaining a profit margin? It's not Hood. It's actually SoFi. SoFi could offer a better rate. They are not currently because they're saying the changes that they've seen in their APYs whenever they slightly lower it or put themselves in the top 20%, but not the top 1%, is that they actually see no changes in their customer behavior in terms of the amount of deposits that they're seeing. So they're being more like traditional finance in that way, where they're saying, hey, we still want to be fast moving, but we don't want to essentially just give away our profits, right? Robinhood is pretty interesting because they're saying, well, I mean, they have drawn back from this in history before, but if they can give it, they will give it. Now, that's not necessarily true all the time. They had a Robinhood matching on the amount of deposits that were coming in. They would match you 1%. They actually realized that showed no changes in deposit deposit behaviors, so they just removed it. In fact, SoFi did it after Robinhood, and they have not removed it. You actually can keep that. If you have auto deposits into SoFi Invest, you'll see a bonus on every deposit that you end up putting it in. That money, when Mexico? Not sure. Actually, I just listened to a podcast recently with Tevis and I on the last Fireside chat with Chris LaPointe, or maybe not the last one, but a little bit ago. And you were on there to ask us the exact same thing when Tevis and I were going to go down to Mexico. Do you buy at $13, $14? I technically bought yesterday. It was a donation, but someone donated and said, I really like SoFi here. And I said, okay, I'll put your donation towards SoFi. So I bought 15 shares of SoFi. So am I buying? Yes. Is that a McDonald's Diet Coke? The best. I'm not drinking the best. It's a iced coffee. And it's the condensation. It's crazy. But yeah. It's McCafe. I love it. Also, the 1% rebate on margin. Nice. Is that, I don't even think I know what you're referring to. If you do automatic deposits, they give you a 1.5% rebate, or is that rebate on margin because of SoFi Invest or something like this? What's the rebate for? Hood's Glassdoor reviews are not inspiring. Wow. I'm sure it would be a pretty hard place to work. I remember whenever we were in San Francisco, we went down to the Uber's headquarters. And this is actually not that inspiring for SoFi or Robinhood in two different lights. But he remembered going and looking at a job offering, the one person that we were speaking to, and he remembered looking at Robinhood and saying, they work way too hard, and I actually don't want to work there because I want to have some level of work-life balance. And he had heard a similar story with SoFi where the work-life balance was actually just a little bit too much life, not enough work. So a little bit both cultures there. But it's not that that's just like Robinhood pays for that level of work-life balance. So their actual expenditures per employee is really high. Tanner, have you talked to Noto recently? Not at all. I mean, I've sent messages. He leaves me on read. And I don't even think he's reading them. He leaves me on sent. But yeah. Where's my Nebius folks? Seems like they're burning everyone out. I mean, that could be true. From what I heard, the C-suite there at Robinhood, they're all maniacs. And then whenever they talk about Vlad, they're like, he is the maniac of maniacs. Like none of us can keep up with him. So, yeah, it must be an intense culture. I definitely would not want to work for Robinhood. That's for sure. Do you ever get frustrated with him not responding to you when you're one of the biggest SoFi public investors? So it's not my place to get frustrated with him. You know, like, I need him much more than he needs me. So I would appreciate a reply, but it's a very small fish talking to, you know, like, I'm very much a believer that this society is like we're living on the shoulders of giants, and he is growing himself into be one of the large giants for sure. I'm not talking Elon Musk level, but I mean, he is definitely running a multi-billion dollar business. It's pretty inspiring, actually. I'm running a small YouTube channel, so he doesn't need to reply. I wish he did, but that's okay. Yeah, I still believe that if they do a product event or investor day, which will happen, okay, I don't, some people think because it hasn't happened, like that it's never going to happen. They will have an investor day, that's for sure. Because I mean, they had one whenever they went public. Maybe they're going to have one, who knows, every 5 years, whatever. That wouldn't really be out of the realm of beliefs. Maybe they are waiting to have a really big pop in their stock and then go public, whatever. Whenever that does happen, especially if it's an in-person one and they're inviting analysts, I would assume I would get an invite. I'd like to think that I could meet him in person. Maybe I'm wrong. The more I think about it, the less I think that that's going to be possible. But whatever. You think we get added into the S&P 400? I think so. I haven't really taken a look at the diversification, how much financials make up for that. But in terms of the mid-cap financial companies, I mean, I'm sure none of them look the way that SoFi does. Okay. I do not believe that he's got things to do. I mean, like, of course he has things to do, but the only thing that, I don't know. Every personality is different, but I always think back to the fact that Jared Isaacman gave me time on a show one time, and he didn't even know who I was. You know, I tweeted at him. I said I had some questions, and he said that there was a misconception with one of my things, and I said, okay, can you come on and explain it? And he said yes. He was running on 31 hours with no sleep during a quarantine period for him to go up to space. So like, I don't know. The busiest people in the world still somehow have time, but I think I'm more of a brand risk than something that I'm taking away from his time. That's really what I think it is. I think that I'm not saying that, like, I don't know. I think retail in general is a brand risk. I'm sure they have lawyers that are convincing them not to talk to me or something along those lines. Because I remember Robinhood before Amit, that was very much their stance. And then after Amit's conversation, they realized how well that worked out. And they realized that creators were actually very compliant because they don't want to have legal issues with large multi-billion-dollar companies. We'd lose that every day. So, you know, we're willing to send the drafts of our conversations. We're willing to do it not live. We're willing to have not just Anthony Noto in the call, but also other people in the call that would oversee the conversation. And that's all the things that I would like to highlight to him is like, I've been doing this, like even with the Jared Isaacman call, it was not like, I called him up one day and he let me pull out the camera and record. I mean, that might be what it seemed like because I was wearing a hoodie or whatever, but like I met with their entire investor relations team. Like there was like three meetings before that, or before that video that actually went live where I was going over things that I could talk about and everything like this. And just to be 100% honest, there was nothing that we couldn't talk about with Jared Isaacman. There was with Robinhood, it was just a bunch of forward-looking stuff that they needed that to be approved before going out because obviously they're a financial, solutions company. So, but like, still, we had their team go through and edit the stuff with one of the videos or with one of the ones where you saw us like sitting with the background and everything. Like that was their camera crew and everything. Like they did all production on that video. They edited it. So, like, I don't know. I'd like to think I've been very compliant with the companies that have entrusted me with that responsibility, but Noto doesn't know me. And they're a newly regulated bank. Overall, I mean, yeah. So I don't know. Plus, like, I mean, look at me. I like he's a fully regulated bank. I'm wearing a t-shirt that's got cat hair on it. But, you know, we still invest in the same businesses, ladies and gentlemen. This is just the luxury that I have. But yeah, I'm going to take full advantage of being me. Did you see the Isaacman podcast, or did you see Jared Isaacman on the All In podcast today? I did. It was absolutely fantastic. And at the end of the thing, he also said, I'm not going to stay unemployed forever. I'm going to go back to shift 4. Boom. But I don't think that he'll be there forever. He also made comments about wanting to do some charity work, wanting to get back into space, solve more really complex issues in life. I don't think that he'll be there forever, but I also know that he's not going to stay not busy. He also said that he's not going to retake the CEO role, and he's going to play more from a like board of directors type thing. And yeah, like the one thing that you guys can learn, and I've been saying this forever, like Jared Isaacman he's going to be one of the all-time greats. And if you watch that interview, it really comes through. This dude is so well researched, so passionate about the companies or the things that he's trying to get involved in. And honestly, it was an absolute shame that he didn't get picked for NASA, because like I think that that's the exact mentality that needs to be in government. Budget conscious, really great ideas, cut the crap, cut the fat, and go after really ambitious goals. Great interview, guys. Great interview. When do they announce the S&P 400 additions? In 2 days, Friday. Do you think Noto's Fireside will give us more than the LaPointe Fireside today? Noto doesn't have one scheduled right now. It's Chris LaPointe in the next one as well. Sagig says, Broadcom is reporting tomorrow after hours. May create some volatility for NVIDIA too. Yeah, I'll probably be live streaming that Broadcom earnings call. Not from a perspective of a understanding investor for Broadcom, but one that wants to learn. Sagig, I do listen and read your comments all the time. I think that a smarter investor would put some shares towards Broadcom as well. Yeah, very important company. But yeah. I'm also just here to learn and learn more about the industry in general. Okay, ladies and gentlemen, thank you all so much for watching this SoFi Fireside and just general conversation. Look out tomorrow for another SoFi video. And actually, hold on. Big news. 8 o'clock tonight, should be 8 o'clock unless they push. We have Brad Freeman coming on. We have Evan's stock market. That's going to be an amazing live stream. We're probably going to be talking about SoFi, NVIDIA, other big news. I got to think about what we're going to talk about, but definitely SoFi and NVIDIA. But yeah, should be lots of fun. Hopefully you guys can all make it out. Thank you all so much for watching. Really do appreciate your time. Bye for now.